All right, let's unlock this world of finance.
Yeah.
We're doing a deep dive today all about the SIE exam.
Yeah,
You know, that crucial first step towards a career in the financial services industry.
absolutely.
We're going to break down this study manual we have here,
Okay.
pull out the essentials you'll need to conquer this beast.
Sounds good.
We'll go through March players, regulations, the ins and outs of stocks and bonds and investment returns.
Right.
Think of this as your cheat sheet to success.
I like it.
And trust me,
Yeah.
there are some surprising things in this manual.
Like what?
Like, did you know that some investors actually try to make money when the market goes down?
It's true.
It's crazy, right?
Yeah, there are strategies out there that thrive on market downturns.
Really?
We'll get to those later.
Okay.
First, let's lay some groundwork.
Right.
Think of the financial world as this big, bustling marketplace
Okay.
with all sorts of players, each with their own roles and motives.
Okay.
You've got your broker-dealers.
Oh, yeah.
They act as intermediaries connecting buyers and sellers,
All right.
but sometimes trading for their own accounts.
So they're like financial matchmakers,
Uh-huh.
but with a little bit of a gambling streak.
Exactly. They operate in both the primary market, where companies issue new securities, and the secondary market, where those securities are traded among investors.
Got it.
Yeah.
And speaking of investors,
Yeah.
there's like a whole spectrum, right?
That's right.
From like everyday people to these massive institutions.
You got it. You've got your retail investors. Those are individuals like you and me.
Okay.
Then you have institutional investors. Those are the big players like pension funds,
Yeah.
hedge funds, insurance companies.
Wow.
Then you have a category called accredited investors.
Okay.
Typically high net worth individuals who meet certain financial criteria.
So it's like a tiered system
It is.
with like different levels of access and regulations.
Precisely. And within this bustling marketplace,
Yeah.
you also have market makers.
Okay.
These are crucial players.
What do they do?
They ensure smooth trading by constantly quoting prices at which they're willing to buy and sell securities.
Oh,
Think of them as the lubricant that keeps the gears of the market turning.
that's a good analogy.
Yeah, without them, it would be a lot harder to buy or sell investments quickly and efficiently.
I can imagine.
Yeah,
That's a role I wouldn't want to have,
really.
especially on a volatile day.
That's fair.
Yeah.
What am I?
All this trading activity, there's
Yeah.
got to be some rules.
Oh, absolutely.
It can't be like the Wild West out there.
You're right. The financial industry is heavily regulated,
I bet.
and for good reason.
Makes sense.
It's all about protecting investors
Oh, okay.
and ensuring fairness and transparency.
So-
think of it as a web of safeguards
Okay.
with layers of rules at the federal and state levels.
Oh, wow.
And then plus you have those set by self-regulatory organizations like FINRA.
Okay.
It can seem overwhelming,
Yeah.
but it's there to protect your interests.
That makes sense. And I'm guessing SIPC,
Yeah.
Securities Investor Protection Corporation,
Uh-huh.
that's part of that safety net?
You bet. Let's say, hypothetically,
Okay.
your brokerage firm goes bankrupt.
Uh,
Well, SIPC steps in.
what do they do?
They protect your investments up to certain limits.
Okay.
So you don't lose everything in that scenario.
Oh, wow.
Yeah. It's like insurance for your brokerage account.
That's a relief.
It is. It gives you peace of mind.
So let's talk about the investments themselves.
All right.
The manual jumps into equity securities,
Okay.
starting with the difference between common and preferred stock.
Right.
So if I buy common stock, I'm basically a part owner of the company.
Exactly. You have voting rights
Oh, cool.
and the potential to benefit from the company's growth through dividends and stock price appreciation.
So like,
It's like having a small slice of the pie.
Oh.
Preferred stock, on the other hand.
yeah.
It's like having a VIP pass.
What do you mean?
You get preferential treatment when it comes to dividends, meaning you get paid before the client stockholders,
Oh, wow.
and you have a higher claim on assets if the company liquidates.
Okay.
But you don't usually get voting rights.
So it's a trade-off.
It is.
More stability and income with preferred stock,
Right.
but potentially less upside compared to common stock.
That's a good way to put it.
So,
And here's where it gets interesting.
oh, tell me.
The manual also talks about convertible securities.
Okay.
Imagine you own preferred stock,
Okay.
but it comes with this special feature.
What's that?
You can convert it to common stock
Really?
under certain conditions.
That's neat.
Yeah, it's like having a 2-for-1 deal.
Oh, wow.
It gives you flexibility depending on how the company and the market perform.
So if the company's about to take off,
Yeah,
you can just convert your preferred stock to common stock
that's right.
and ride that wave.
Exactly. It's a clever way to adapt to changing market conditions.
Wow.
So,
Okay, so we've covered the basics of equity securities. What about the other side? Debt instruments.
Debt instruments are also known as bonds.
Okay.
They represent loans made to governments or corporations.
All right.
When you buy a bond,
Yeah.
you're essentially lending money to the issuer
Oh, okay.
in exchange for periodic interest payments and the return of your principal at maturity.
So bonds are like IOUs,
Yeah, that's a good analogy.
but with a much better interest rate than what I give to my friends.
Hopefully. The manual covers a range of bonds from U.S. Treasury securities,
Okay.
which are backed by the full faith and credit of the government,
Oh, wow.
all the way to municipal bonds issued by state and local governments,
Right.
which can offer tax advantages.
Okay.
And then you have corporate bonds,
Yeah.
which vary in their degree of risk,
Makes sense.
depending on the financial health of the issuing company.
So it's all about assessing the risk and the reward.
Yes.
You know, you go for safety, you go for treasuries.
Yeah.
But if you want to take on more risk for potentially higher returns,
Yeah.
you might go for corporate bonds
Right.
from companies with solid track records.
That's the key takeaway. Each type of bond has its own risk profile and potential return.
Gotcha.
So understanding these nuances is crucial
Yeah.
for making informed investment decisions.
Yeah, I am curious about something.
What's that?
The study guide mentions bond yields.
It does.
What are those?
Think of bond yields as a measure of the return you can expect
Okay.
from a bond.
All right.
There are two main types:
Okay.
current yield
Okay.
and yield to maturity.
Got it.
Current yield is simply the annual interest payment
Okay.
divided by the bond's current market price.
Oh, okay.
It gives you a snapshot of the bond's return
At a point in time.
at a specific point in time. Yeah.
So it's like a quick calculation to see how much income you're getting
Right.
from the bond relative to its price.
Exactly.
Got it.
Yield to maturity, on the other hand,
Okay.
it's a more comprehensive measure.
Okay.
It takes into account the price you paid for the bond. Oh, wow.
The interest payments you'll receive over its lifetime
Right.
and the principal you'll get back at maturity.
That makes a lot of sense.
It does. It
Okay.
gives you a better picture of the bond's overall return, assuming you hold it until maturity.
Got it.
Yeah.
So if I'm planning to hold a bond for the long haul,
Yeah.
yield to maturity is the more relevant figure.
You got it. And remember, bond yields are constantly fluctuating.
Oh, I bet.
Yeah, as interest rates and market conditions change.
Makes sense.
So it's important to keep an eye on them
To see.
to understand how your bond investments are performing.
Okay, so we've covered the building blocks, stocks and bonds,
We have,
but there's a whole other world out there,
there is,
right?
yeah.
The manual touches on packaged products like mutual funds,
It does.
which sound like a pretty convenient way to diversify your investments.
You're right. Mutual funds pool money from multiple investors
Okay?
to purchase a diversified portfolio of securities,
All right.
all managed by professional portfolio managers. So instead of picking stocks and bonds myself,
Yeah.
I could just buy a mutual fund that already has a mix of investments.
Exactly. And there are mutual funds for every taste and risk appetite,
Oh, wow.
from those focusing on specific sectors like technology or healthcare
Okay.
to those tracking broad market indexes
Got it.
like the S&P 500.
It's like a one-stop shop for building a portfolio.
It is, but there are different types of mutual funds.
Oh, okay.
Yeah. The manual mentions something about share classes and fees.
Right.
So
Yeah.
there are different share classes with varying fee structures.
Okay.
Some funds charge a front-end load, which is a sales charge you pay when you purchase shares,
Right.
while others have a back-end load, which is a charge paid when you sell shares.
Got it.
Then you also have no-load funds
Okay.
that don't charge any sales charges at all.
So you got to pay attention to those fees you do
Yeah.
because they can eat into your returns.
Absolutely. And don't forget about the other types of packaged products mentioned in the manual, like unit investment trusts
Okay.
or UITs,
Got it.
which hold a fixed portfolio of securities for a set period,
Right.
and closed-end funds,
All right.
which issue a fixed number of shares that trade on exchanges just like stocks.
So many options.
Yeah.
It's a lot.
Right. But speaking of options,
Yeah.
there's a whole section dedicated to those.
There is.
And this is where I start to get a little fuzzy.
Oh, yeah.
What exactly are options?
Options are contracts that give you the right, but not the obligation
Okay.
to buy or sell an underlying asset at a specific price,
Right.
called the strike price, on or before a certain date, the expiration date.
Okay.
There are two main types,
Okay.
calls and puts.
So a call option lets you buy something,
Yes.
and a put option lets you sell something.
No.
Why would I want to do that?
Options can be used for various strategies, both speculative and hedging.
Like how?
So, for example, if
Yeah.
you think a stock price will go up, you can buy a call option.
Giving you the right to buy the stock at a predetermined price.
Okay.
If the stock price rises above that strike price,
Yeah.
you can exercise your option.
Okay.
Buy the stock at the lower price
Right.
and make a profit.
So it's like a leveraged bet on the stock price.
Exactly. And puts work in the opposite way.
Nope.
If you think a stock price will go down,
Yeah.
you can buy a put option,
Wait.
giving you the right to sell the stock at the strike price.
Right.
If the stock price falls below the strike price,
Uh-huh.
you can exercise your option, sell the stock at the higher price,
Okay.
and again make a profit.
My brain hurts.
It's a lot, isn't it?
But I'm starting to get it.
Good.
Options let you profit from price movements,
They do.
but they come with their own risks
Absolutely.
and complexities.
You're right. Options are powerful tools,
Yeah.
but they require a thorough understanding of how they work
Okay.
and the risks involved.
It seems like the financial world is full of all these
It is.
like instruments and strategies.
Yeah. Yeah, it's a lot to take in.
But we're going to break it down,
We will.
one step at a time.
That's the key.
So what's next on our journey here?
Let's explore how companies raise capital through offerings
Okay.
and the regulatory hurdles they face,
Right.
and the different types of orders and trading strategies used in the marketplace.
Sounds like we're about to uncover another layer of the financial onion.
We are. It's exciting.
Let's peel it back and see what we find.
I'm ready.
Welcome back to our deep dive into the SIE exam.
Yeah.
Last time we went through market participants,
Yeah.
regulations, the world of stocks and bonds, and those packaged products.
Yeah.
But there's more to uncover right now.
Absolutely. Let's shift gears a little bit
Okay.
and talk about you as an investor interacting with the market.
Oh,
You know, when you open up a brokerage account,
Yeah.
it's kind of like setting up shop
Right.
in the financial marketplace.
Got it.
But before you can start trading, you'll encounter something called the KYC rule.
KYC.
Know your customer.
What's that?
It's all about protecting you and the financial system from bad actors.
Okay.
Brokerage firms are required to verify your identity,
Oh,
understand your financial situation,
wow.
even assess your investment objectives.
So it's not just about the paperwork.
No, it's not just about the paperwork. It's about
responsible investing.
Exactly. Now, once you're set up,
Yeah.
you're going to need to choose the type of account
Okay.
that aligns with your investment style.
Got it.
The study guide talks about cash and margin accounts.
Oh, yeah. Margin accounts.
Right.
You can borrow money to amplify your investments, right?
You can.
Sounds a little risky.
It can be, but it's important to understand the risks.
Okay.
With a margin account, you're essentially using leverage,
Okay.
which can magnify both gains and losses.
Right.
The manual goes into detail about margin agreements,
Okay.
marginable securities,
Ugh.
and margin calls.
Margin calls.
Yes,
Those sound scary.
they can be. Imagine this.
Okay.
You buy stocks on margin,
Right.
and the market takes a downturn.
Yeah.
And if your account value drops below a certain level,
Yeah.
your broker will issue a margin call,
What does that mean?
requiring you to deposit more funds
Really?
to cover your potential losses.
So it's like the broker saying,
Yeah,
hey, you owe me money.
basically. So while margin can be a powerful tool,
Okay.
it's crucial to use it cautiously
Got it.
and understand the potential downside.
Proceed with caution.
Exactly. Now, the study guide also mentions discretionary accounts.
Discretionary accounts.
Yes.
What are those?
Those are accounts where you grant someone else,
Okay.
typically a financial advisor,
Right.
the authority to make investment decisions on your behalf.
So you're giving them the keys to your financial car.
Ooh, basically.
It takes a lot of trust. You're handing over control of your money.
You're right. It's crucial to have a strong relationship with your financial advisor. Define your investment objectives
Right.
and have open communication channels
Got it.
before granting them discretionary authority.
Okay.
The manual also highlights the difference between fee-based and commission-based accounts.
Oh, yeah. What's the difference?
So in a commission-based account,
Yeah.
you pay a commission
Okay.
for each trade.
Got it.
Your advisor executes
Okay.
on your behalf.
Right.
In a fee-based account,
Yeah.
you pay an ongoing fee,
Okay.
often a percentage of your assets
Right.
under management.
Regardless of trading activity.
Exactly.
Got it.
The best choice depends on your trading style
Okay.
and frequency.
So if I'm a buy and hold investor,
Yeah,
a fee-based account makes more sense.
probably.
But if I trade a lot,
Then a commission-based account would be more cost-effective.
that makes sense.
It does.
Yeah.
Now, let's move on to trust accounts.
Trust accounts.
These are often used for estate planning purposes,
Okay.
so ensuring that your assets are managed. for your beneficiaries,
Okay.
like perhaps your children
Yeah.
or individuals with special needs.
So it's like setting up a financial safety net
It is.
for your loved ones.
Exactly. A trustee is appointed
Okay.
to manage those assets,
Got it.
according to the trust document.
That sounds like a good idea
Is.
for anyone concerned about the future.
Absolutely. And speaking of the future,
Sure.
the study guide dedicates a large portion to retirement accounts.
Retirement accounts.
Yes.
I'm all ears.
These are essential financial vehicles
Okay.
designed to help you accumulate savings
Yep.
for your golden years.
Retirement might seem far off,
It might.
but I know it's never too early to start.
You're absolutely right.
So what are the key things here?
So the manual covers traditional and Roth IRAs.
Individual retirement accounts.
Yes, which offer tax advantages for long-term savings.
Okay.
With a traditional IRA, your contributions may be tax deductible.
Yeah.
And then the withdrawals in retirement are taxed.
Okay.
Roth IRAs use after-tax contributions,
Okay.
but qualified withdrawals in retirement are tax-free.
So traditional IRA, you get a tax break up front.
Uh-huh.
Roth IRA, you get a tax break later.
Exactly. Choosing the right type depends on your circumstances,
Right.
your income level,
Okay.
and tax bracket.
The manual also discusses qualified plans,
It does.
like 401k.
Right.
Those are employer-sponsored
They are?
that often come with matching contributions.
Yes, they do.
That sounds great.
It is. It adds extra oomph
Yeah.
to your savings.
Matching contributions are like free money.
Basically. So if your employer offers a 401k,
Yeah.
it's generally wise to contribute enough
Okay.
to take full advantage
Yeah.
of any matching they provide.
Retirement accounts are a must.
They are.
Now, switching gears a bit,
Okay.
the study guide talks a lot about compliance considerations.
It does.
Why is that such a big deal?
Well, it's all about maintaining a fair,
Gotcha.
transparent, and trustworthy financial system.
Got it.
You know, all those layers of regulations.
Oh, yeah.
Compliance ensures everyone plays by the rules.
It's like keeping the bad apples out
It is.
and protecting investors from unethical practices.
Precisely. The manual covers a range of compliance topics, starting with the USA Patriot Act,
Oh, the Patriot Act.
which strengthens anti-money laundering measures.
Okay.
It requires financial institutions to
Yeah.
implement robust compliance programs
What do those do?
to detect and prevent suspicious activities,
Like what?
like transactions
Okay.
that might fund terrorism.
It's like a security system for the financial world,
It is.
safeguarding against all the bad guys.
Yes, exactly.
Then there's Regulation SP.
There
What's
is.
that about?
That focuses on protecting your privacy
Okay.
and safeguarding your non-public personal information.
All right.
It requires financial institutions to
Yeah.
establish clear privacy policies,
Okay.
provide notices to customers, and implement security measures to protect sensitive data.
So it's like a privacy shield
Yeah,
for my information.
exactly. And then you have communication rules.
Communication rules.
These dictate how financial professionals interact with their customers and the public.
Okay.
There are clear distinctions between correspondence,
Okay.
retail communication,
All right.
and institutional communication,
Got it.
each with its own set of rules
Okay.
to prevent misleading information.
So making sure the communication is
Yes,
clear, accurate, and fair.
exactly.
Now,
Yeah.
let's talk about prohibited activities.
Okay.
The study guide outlines the actions that can get you in trouble.
Yeah, like market manipulation,
Market manipulation,
insider trading,
insider trading,
front running,
front running.
and churning.
Whoa, those sound pretty serious.
They are.
What do they involve?
So market manipulation
Yeah.
involves artificially influencing security prices for personal gain.
Okay.
Like imagine spreading false rumors to pump up a stock price.
Oh, wow. And then dumping all your shares
Oh,
to unsuspecting investors.
so Regulation M targets that.
Yes, it governs the activities of underwriters
Okay,
in follow-on offerings
right.
to ensure they don't rig the market price of a newly issued security.
Makes sense.
Yeah.
It's all about protecting investors.
Exactly. Then you have insider trading,
Insider trading, yeah.
using material, non-public information
All right.
to profit from trades.
Okay,
Imagine a company executive who knows about an upcoming merger
right.
that's going to boost the stock price.
Okay.
They buy shares based on that information.
That's not fair.
That's insider trading.
It's like playing poker with a marked deck.
Exactly.
The other players don't stand a chance.
And then there's front running.
Okay, what's that?
That involves a broker-dealer executing trades for their own account
Okay,
before executing a customer's order.
so they're taking advantage.
Yes, of the anticipated price movement.
Oh, wow.
caused by the customer's order
It's like cutting in line.
at the trading desk.
Basically.
And then you have churning.
Churning is excessive trading in a customer's account,
Oh.
just to generate commissions for the broker.
Even if it doesn't benefit the client.
Even if it doesn't, yes.
That's messed up.
It is. It's a breach of fiduciary duty, putting the broker's interests ahead of the client's.
That's like a doctor ordering unnecessary tests.
That's a good analogy.
Yeah.
These prohibited activities are taken very seriously
Okay.
and can lead to severe consequences,
Makes sense.
like fines, license revocation, and even imprisonment.
It's not just about knowing the rules.
No.
It's about being ethical.
Absolutely.
The SIE exam emphasizes ethical conduct.
It does.
The financial industry relies on that.
It does.
Now, the study guide also mentions
Yeah.
Form U4,
Uh-huh.
Form U5,
Yes.
Form U6.
Yeah.
What are those?
Think of Form U4 as your application for registration as an associated person with FineRI.
Okay.
It's a comprehensive document. It requires information about your background,
Like what?
employment history, disciplinary actions,
Okay.
financial disclosures.
Wow, it's like a big background check.
It is. It's like a resume and background check rolled into one.
So they're weeding out the bad apples.
Exactly.
And Form U5.
That comes into play when a registered person's employment with a member firm is terminated.
Oh, okay.
It provides details about the termination.
Okay.
Any customer complaints or disciplinary actions.
It's like an exit interview
Basically.
for the financial world.
Yeah.
So Form U6.
Form U6 is used to report disciplinary actions taken against a registered person or a member firm.
Oh, okay.
It's like a public record of regulatory infractions,
Right.
transparency, and accountability.
FINR's broker check website.
Yes.
That lets investors see this info, right?
It does.
They can make informed decisions.
Exactly.
Yeah.
Now, what about those investor education initiatives mentioned in the manual?
Investor education initiatives.
Yeah.
What are those?
FINRA and MSRB,
Okay.
the Municipal Securities Rulemaking Board,
Right.
both have investor education programs
Clear.
to promote awareness
Right.
and understanding of financial concepts, regulations, and investor protection measures.
It's like a financial literacy boot camp.
It is.
The manual also outlines the process.
Yeah. For handling and reporting customer complaints,
Okay.
it's important to have a clear system
Yeah.
for addressing grievances.
So if I have a problem with my broker,
Yes,
I have a way to file a complaint
you do.
and seek resolution.
Exactly. Firms are required to take those complaints seriously,
Okay.
investigate them thoroughly, and document their findings.
That's good.
Certain complaints have to be reported to regulators,
Hopefully.
providing an extra layer of oversight.
That's reassuring.
Now,
Yeah.
the study guide also touches on private securities transactions.
What are those?
Those are deals done outside the scope
Okay.
of a registered person's employment with a member firm.
Oh.
These transactions require full disclosure
Okay.
to the employing firm and might even require approval.
Makes sense.
It's all about avoiding conflicts of interest,
All right.
ensuring that these transactions are
Yeah.
conducted ethically
Right.
and comply with regulations.
Transparency is key.
It is.
Speaking of transparency,
Yeah.
the manual also covers political contributions.
Yes.
Why are those relevant?
Well, municipal finance professionals,
Okay.
or MFPs,
Got it.
are involved in the underwriting and trading of municipal bonds,
Right.
which are issued by state and local governments
Right.
to prevent conflicts of interest.
All right.
MSRB Rule G37 restricts political contributions
Yep. Flat.
that MFPs can make to officials who can influence the awarding of municipal securities business.
So preventing someone from giving money
Yes,
to get special treatment.
exactly.
It's all about being fair.
Yes.
This deep dive is taking us
Yeah.
behind the scenes of the financial world,
It is.
uncovering all these rules and regulations. Now let's zoom out a little.
Okay.
Talk about broader economic factors that influence the markets.
All right.
I'm guessing the manual covers things like economic indicators,
It does.
monetary policy,
Yeah.
fiscal policy.
It does.
Economic factors are like the weather patterns
Yes.
of the financial world,
It's a good analogy.
shaping market conditions.
Yeah.
The manual describes business cycles.
It does.
Those are like the ups and downs.
Yeah.
Right?
The recurring periods of expansion and contraction.
It's like a roller coaster ride.
It is.
Each phase has its own implications.
It does.
The study guide also covers economic indicators.
Yeah.
Those are like
Data points.
that give you a peek into how the economy's doing.
They do.
Give me some examples.
Leading indicators like building permits,
Okay.
consumer confidence,
Okay.
suggest future economic activity.
Right.
Lagging indicators like the unemployment rate,
Okay.
corporate profits,
Right.
reflect past economic performance. Coincident indicators,
Yeah.
like industrial production,
Okay.
retail sales,
Right.
track current economic conditions.
So it's like you have a dashboard
Mm-hmm.
for the economy,
Yeah.
giving you real-time updates.
Exactly.
Now, what about monetary policy?
Monetary policy, those are the actions taken by central banks,
Like the Fed,
like the Fed.
to influence the money supply
Yes,
and interest rates.
correct.
So the Fed's kind of like the conductor of the economic orchestra.
Oh, that's a good way to put it.
What about fiscal policy?
Fiscal policy refers to the government's use of spending and taxation
Right.
to influence the economy.
Okay.
So, like, increasing government spending can stimulate economic activity,
Okay.
and tax cuts can boost consumer spending
Makes sense.
and business investment.
This is turning into an economics crash course.
A little bit, yeah,
But I see how everything's connected.
it is.
All part of one big ecosystem.
Exactly.
Now let's wrap this part up.
Okay.
Talk about investment risks.
Investment risks.
Yeah.
Every investor
Mhm.
needs to understand and manage these risks
Okay.
inherent in the market.
Last time, we talked about systematic
Yeah.
and unsystematic risks.
Correct.
Can we unpack that a bit more?
We can.
Welcome back to the final part of our SI exam deep dive.
We're in the home stretch.
We've covered so much,
We have.
the market players, the regulations, account types, those prohibited activities.
Yeah, it's been a whirlwind.
But we have one more crucial topic to cover.
What's that?
Investment risks.
Ah, yes, risks.
We can't forget about those.
The heart of the matter.
Last time we were talking about systematic
Right.
and unsystematic risk.
Yeah.
We could unpack that a bit more.
Yeah, absolutely. So think of systematic risk
Okay.
as this tide
Okay.
that raises or lowers all the boats
All right.
in the harbor.
Got it.
It's the inherent risk
Okay.
of investing in the market itself,
Makes sense.
driven by factors like economic downturns, geopolitical events, natural disasters,
Oh, wow.
all those things.
So no matter how much I diversify,
Yeah,
I can't fully escape that.
that's right. That's the price of admission to the investment game.
Okay.
But here's where unsystematic risk comes in.
Okay, tell me.
This is like the risk that's specific
Okay.
to a particular ship, perhaps,
Right.
because of design flaws
Right.
or poor navigation.
Okay.
It's the risk associated with a specific company, industry, or security.
So a company could have bad management
Yeah,
or face increased competition,
right.
and that would be unsystematic risk.
Exactly. And the good news is
Oh, good news.
unsystematic risk can be mitigated
I'll-
through diversification.
Diversification
Spreading your investments,
across different things.
different asset classes,
Okay.
industries, companies.
Got it.
So you reduce the impact of any one investment going sour.
So diversification is like
Yeah.
not putting all your eggs in one basket.
Yeah. It is. That's a great analogy.
The study guide goes deeper into specific types of investment risks.
It does.
One that often comes up is interest rate risk.
Yeah. Interest rate risk primarily affects fixed income investments,
Okay.
like bonds.
Okay. Interest rates, I know those are always fluctuating,
Yeah, they are.
but how do they impact my investments?
Imagine you buy a bond
Okay.
with a fixed interest rate of 5%,
Yeah, 5%. Okay.
and then interest rates in the market go up to 6%.
Okay.
Now your bond is less attractive
Because
for investors
there are better options.
because they can buy newer bonds with a higher yield.
So my bond's value would decrease.
Most likely, yes.
Okay.
It's an inverse relationship.
Got it.
When interest rates rise, bond prices fall,
Makes sense.
and vice versa.
It's like a seesaw.
It is.
What other risks are there?
Well, the manual also covers inflation risk,
Okay.
also known as purchasing power risk.
Okay.
This is the risk that rising inflation
Yeah.
will erode the value of your investments,
Even if my investments are growing.
even if they are.
Wow.
If inflation is higher, your money just won't buy as much.
It's like inflation is stealing from me.
That's a good way to put it. Then there's event risk.
Event risk.
This is the risk of some sudden, unexpected event
Okay.
that impacts the market,
Like what?
like a natural disaster, political upheaval, terrorist attack.
Those sound hard to plan for.
They are. It's challenging to predict these specific events.
So how can you deal with that?
Well, you can diversify your portfolio geographically,
Okay.
so you reduce exposure to risks in any one region.
What other risks are there?
The manual also covers business risk,
What's that?
the risk that a company will perform poorly.
Oh,
leading to a decline in its stock price.
So you got to pick a good company.
You do. Then there's liquidity risk.
Liquidity risk.
This is the risk of not being able to sell an investment quickly at a fair price.
Oh, okay.
This is particularly relevant for less liquid assets,
Okay.
like real estate or private equity.
Makes sense.
Those things can take time to sell.
So liquidity risk is like
Yeah.
trying to sell a house in a bad market.
It is. You might have to lower the price
Right.
to find a buyer.
And finally, regulatory risk and political risk.
Yes. Regulatory risk is the risk of changes in government regulations
Okay.
that can impact investments.
Right.
Political risk is the risk of political instability
In a foreign country.
in a foreign country
Okay.
that can harm investments.
So many risks.
There are.
But I'm seeing some patterns.
Oh, yeah. Like what?
You can mitigate a lot of these
Yeah.
through diversification,
Yes.
careful research, staying informed.
You're absolutely right. The study guide also emphasizes risk management strategies.
Like what?
We already talked about diversification.
Right.
But you can also use asset allocation.
Oh, yeah. What's that?
That's figuring out the right mix
Okay.
of stocks, bonds, and other asset classes.
Okay, so now,
Your risk tolerance,
right.
investment goals,
Right.
and time horizon.
So if I'm young,
Yeah.
I should have more stocks.
You could, yeah.
But if I'm closer to retirement,
Yeah.
I might want to shift to more bonds.
You might, yeah.
And the manual also mentions rebalancing.
It does.
This-
Adjusting your portfolio
Okay.
back to your target asset allocation.
Okay.
Because the market fluctuates.
Right.
And some investments do better than others.
So if my stocks did really well,
Yeah.
but my bonds didn't,
Uh-huh.
I might sell some stocks and buy bonds.
Right. To rebalance.
Makes sense.
It's like pruning a garden
Oh, cool.
to make sure everything has space to grow.
And then there's hedging.
Hedging involves using strategies like options or futures
Okay.
to offset potential losses.
So it's like insurance.
Yeah, it's
Yeah.
like buying insurance for your investments.
This deep dive has been incredible.
Well, it's been a journey.
We've covered so much,
We have.
from market participants to risk management.
It's been a pleasure.
I feel like I have a whole new understanding
That's great to hear.
of the financial world.
This is just the beginning.
Yeah.
The SIE exam is just the first step.
Okay.
It's a foundation upon which you can build a successful career.
Right.
And even if you're not pursuing a career in finance,
Yeah.
this knowledge can help you.
With my personal finances.
Exactly.
We've enjoyed this deep dive.
We have.
We wish you the best of luck on your exam.
And beyond.
Remember, financial learning is a lifelong pursuit.
It is.
Keep exploring and asking questions.
Absolutely.
The financial world is always changing.
It is. It's constantly evolving.
A well-informed investor is an empowered investor.
Couldn't have said it better myself.